welcome to Dollars and Making Sense, a weekly show about finance, money and investing. I'm your host, Ray Treverson. I'm from OTG Capital. We broadcast locally on Radio Northern Beaches and around Australia on the Community Radio Network, complements of the Community Broadcasting Association of Australia. Now, that particular network of community radio stations actually is about 450 radio stations, which is quite expansive when you think about this wide country of ours. We get picked up by about 14, 15 regional stations. And I always like to say a big hello to our regional stations that do pick us up. We really appreciate it. And for those that are considering it, hey, it's a free feed. So, we're here all about education. And in the light of education, we're really pleased to welcome back to the show today, Stuart Sheary, who is a subject matter expert from the Institute of Financial Professionals of Australia. Now, this organisation has been going for over 100 years, and it's most commonly been known as the Taxpayers Association. It's had a few name changes of late because everything keeps changing, doesn't it, Stuart?
Absolutely. The tax system, the super system, it's all changing, which is great.
So welcome back. And those of you that are interested, if you go back and look at our blog archive, you'll see that Stuart has been on the show a number of times. And, there are really cool subjects in there. And we've got some stuff there about pensioners' side hustles, how they make a bit of extra money. We've also looked at, what are the benefits available if somebody dies within the super system. So there's a lot of very good things in there, and it's all education, ladies and gentlemen. It's all education. So what we're covering today, again, is one of these interesting things that I don't get involved in all that much because in my time, I'm into my 60s now, and I've never really been made redundant because I've been primarily in the private enterprise space. We just tend to get shot in the head, and Stuart and I were joking about this beforehand, but the idea of redundancy or voluntary redundancies has never really crossed my path. But I've bumped into a lot of people that recently, they use this term VR, voluntary redundancy. So Stuart's on the show today to talk about redundancy and retirement. And again, it's just one of those things. There's a lot to consider, isn't there, Stuart?
A lot to consider. And and if you understand the rules, you can actually save a bit of money through some strategy.
Well, let's talk about saving money because we love freebies on this station and we love talking saving money. So that's great. So look, when someone's employment ends, what kind of payments do they expect to receive, and should they expect to receive?
Good question. So when your employment comes to an end, obviously you're going to get paid out your annual leave, your long service leave, and any salary that's owing to you. But you also may get what we call colloquially a termination payment. And your termination payment can vary depending on how your employment terminated. So there's like three ways that your employment might be terminated. Typically, it's the employee terminating their employment. They're saying, I quit. Okay? They resign. Then the employer might terminate employment. They might say, look, your role is no longer required. Look, you did a great job, but we don't need you anymore. And so we're making you redundant. So the employer makes you redundant, or terminates employment rather. And then there's a third way, and that's a termination by mutual agreement. And so in that scenario, both the employee and the employer, collectively, they kind of agree that things may not be working out. And so the employee hasn't been misbehaving, so they don't deserve to be sacked, but maybe there's a personality clash in the organization, what have you, but they both agree to go on their separate ways. So the employee and the employer agree to, the employee basically terminates their employment. But in that kind of scenario, you might get a different set of termination payments. So for example, when you're made redundant, you may receive a redundancy payment. When you leave through mutual agreement, like I just mentioned there, where things just aren't working out, you might get something called an ex gratia payment. So the types of termination payments you receive will come down to the circumstances in which you leave employment.
So what is the difference between a redundancy payment and an ex gratia payment then? Because ex gratia, if by Latin, that means it's free. It's a free payment.
It's like a goodwill payment. So redundancy, again, is where your role has genuinely come to an end, and by law or by contract or an agreement, you'll be paid out an amount typically relating to the number of years of service. So you receive a redundancy amount. Where an ex gratia payment may be paid upon genuine redundancy, but often it's also paid where there's voluntary resignation, or there's been a mutual agreement that things aren't working out. So, for example, the employer might pay an amount that they don't have to pay. So an ex gratia payment is basically something the employer is not obliged to pay, but they're paying it out of goodwill. And typically, some people think of it as a let's stay out of court payment almost. So things didn't work out, and the employer and the employers kind of agreed that, look, you're resigning, and you go on your separate way, but don't come back 6 months down the track and say, you're pushed out, for example. So it's
but Stuart, when I hear that kind of language, and given that in the last 5-10 years in the Me Too movement, there's been a lot of women specifically that I guess that personality clash, or they decide that they can't work in the same environment anymore. Ex gratia payments almost sound like not a bribe. I don't like to use that word, or corrupt payment, but it's simply a way of saying, look, we're not going to get on. We don't want to have a fight in public. So look, here's a payment in lieu of us going to war, and we all go our separate ways. And usually I've seen, for example, NDAs, non-disclosure agreements, get signed. Is that the kind of thing that you're talking about when ex gratia payments get used?
That is possible, and maybe that's on the extreme end of things. But often ex gratia payments are, look, it's just not working out. Like, there's a personality difference. There's no bullying involved. But by agreement, the employer an employee want to keep things on good terms, and so the employer might pay an extra amount to help the employee go on their way. So not always help
them go on their way.
That's an ex gratia. That said, too, now let's talk in terms of redundancy. An ex gratia payment might be, you're talking about voluntary redundancies. Okay, well, let's say we've got 10 engineers, we only need 5. We don't want to go through and pick who to go, so we might say, look, we're offering voluntary redundancies. They're genuine in the sense that these 5 roles need to go. We don't really want to choose, be pointing out who should go, but we're going to sweeten the deal by giving you an extra amount if you accept this redundancy. So it's an amount we're going to pay you over and above what we have to legally if you accept this voluntary redundancy. That's another example of an ex gratia payment.
I guess, it fascinates me. I spent a number of years in Telstra at a time in the 90s when it was changing from being wholly government into, this mid stance, being a private enterprise, and trying to sort of have feet in both camps. And when voluntary redundancies started being handed out in order to reduce workforce, it was usually the engineers they really didn't want to lose were the first ones putting their hands up, because they're the guys and ladies that thought, beauty, I can get a gig outside, no problems. And so it creates some real HR issues as well. I guess, does the employer, when these are being handed out, is there discretion that can be applied, or is that very much a case-by-case basis? Maybe I'm going into too much detail here, but I've seen it where it can go awry and all of a sudden have unintended consequences.
Yeah, there can be, like, say, perverse incentive. Anyway, it can lead to outcomes that you don't want, right? You're absolutely right. I'm not an expert in the area of HR, but there is always discretion there. And that discretion there from the employer, it's the employer who at the end of the day chooses, but that's also partly for tax reasons, because you want it to be a genuine redundancy. So the employer actually does, if you put your hand up, the employer will go, I'll consider that, the fact that you put your hand up, and yeah, I'll choose you. And it comes with tax benefits by virtue of the fact that the employer has made that decision. It's not the employee who's really calling the shots here. The employer has decided to make you redundant because there's a role that's not needed, and the fact that you put your hand up was an influential factor.
So if I extrapolate what you've just said, then from an employee's perspective, it's better if you are offered redundancy rather than putting your hand up. Is that correct? From a tax perspective?
From a tax perspective, we want it to be a genuine redundancy. And so in the voluntary redundancy scenario where you put your hand up, that would still lead to the same tax outcome as if you were chosen, because in both scenarios, you're chosen. It's voluntary, but the employer still chooses you to be made redundant.
Okay.
They've helped their decision, basically.
Okay. No, that's good. That's good. So I guess that it leads to the next question then. Can you explain how redundancy entitlements differ. Now, interestingly, in your supporting notes that I've read through, you might also explain to the listeners and viewers what a national employment standard is and how that varies between enterprise agreements. And these are two terms I've certainly heard about enterprise agreements a lot. You get mentioned in the media and when business goes to war with unions and they're talking about enterprise agreements, but I've not seen national employment standard used before. So can you explain the difference?
Well, the National Employment Standard is a statutory minimum that employers must pay if they are making a role redundant to their employees. So it basically provides a floor. So as a minimum, if you are made redundant and you have X number of years of continuous service, the employer must pay X amount. Now, some employers, I think some small employers might be exempt. It's outside my scope. I'm not too familiar with industrial relations law or the Fair Work Act. So some employers may be exempt from the National Employment Standard, but it provides basically a floor, a minimum amount that must be paid. Enterprise agreements, on the other hand, it generally it applies to all the employees in that firm, and are generally more generous than the National Employment Standard. So they might offer 20 weeks of pay upon being made redundant when the National Employment Standard might only be 10 weeks, for example.
Okay. And so is there a cap on these entitlements under the NES?
There is. So after 10 years, you cannot accrue more redundancy amount. So typically your redundancy amount is a multiple of the, they take into consideration the number of years of service, and they apply your weekly salary, multiply that by a multiple that's based on the number of years of service, and you'll get an amount of money. And as I mentioned, after 10 years, that's the maximum you can get. And with, so that's capped out. Whereas an enterprise agreement, it depends on the agreement. So you could continue to accrue larger and larger amounts of redundancy based on more and more years of service. And it really comes down to that agreement.
It ends up being a case-by-case basis in a lot of instances, particularly if enterprise agreements are involved. So look, we're about halfway through today's show. You're on Dollars and Making Sense, a weekly show about finance, money and investing. We have Stuart Sherry from the Institute of Financial Professionals. We're talking about redundancy and termination payments. Wow, it's a good subject. We're going to take a short break and we'll be back with you in just a moment. Hi, and thank you for listening to Dollars and Making Sense, a weekly radio program about finance, money and investing on Radio Northern Beaches and nationally on the Community Radio Network around Australia. The views, comments and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation or needs. You should consider whether the advice is suitable for you and your personal circumstances. If in doubt, you should contact an authorised licensed financial planner. We welcome questions and feedback, and you can get in touch with us via our blog, social media channels or email. Please search for Dollars and Making Sense in your favourite podcast platform or check out our blog at otgcapital.com.au/blog. Hi, and welcome back to Dollars and Making Sense, a weekly show about finance, money and investing. I'm your host, Ray Treverson. I'm really pleased to have at the microphone today Stuart Sherry from the Institute of Financial Professionals, and we are talking about redundancies and termination payments. Now, I guess, Stuart, before we went to the break, we were talking about how different payments and different agreements will impact how much somebody that's taking redundancy gets. So let's move on. I guess the frameworks and the like, but there are taxation implications because all of a sudden somebody's getting a big lump of money. And I guess when we're talking about, these are called employment termination payments or ETPs. And again, that's a three-letter acronym that people will have seen a lot. ETPs is out there. So how does the ETP differ in the form of other types of termination payments?
Yeah, so ETP is like a tax jargon, right? So when we talk about termination payments, we might just be meaning anything paid on termination of employment. But not everything that you're paid upon termination of employment is necessarily an ETP. So an ETP is defined under tax law. And so if that termination payment is an ETP, it enjoys concessional tax treatment.
Okay, and concessional tax treatment basically means it's a discount, isn't it?
Yeah, so it's that termination payment would be subject to a maximum rate of tax. And so if you're, for example, at or above preservation age, which is 60 years of age, the maximum rate of tax you would pay on that eligible termination payment is 17% if we include the Medicare levy. And if you're below preservation age, which again is 60, the maximum rate of tax that you'd pay on that ETP is 32%.
Okay, so that makes a big difference. So if someone's close to 60, they might want to go back and have a chat and say, just hold off for however much time. But look, one of the things we were talking about before the break, we were talking about what's genuine and not. And I guess what makes a redundancy genuine in the eyes of the tax office, and why is this important for tax purposes?
Great point. So for tax purposes, we like genuine redundancies because an amount of that redundancy payment will be received tax-free based on the number of years of service. So the ATO will say basically, okay, that was a genuine redundancy. And so the first, from memory, $13,100 is tax-free, and we're going to add on an extra $6,500 thousand of tax-free amount for each year of service, meaning if you're paid $100,000 as a redundancy payment, you might have a substantial amount of that being paid tax-free if you've been working there for a number of years. For it to be a genuine redundancy, the role must genuinely come to an end. So there can't be any agreement or understanding that you'll be going back. Of course, the employer can't then hire somebody else for the same role the next day. So it must be genuine. And you also must be below pension age of 67. So if you're above the age of, if you're 67 or above, it could still be genuine in the sense that the role is no longer required, but you won't get that tax-free amount under tax law.
Yeah, and that starts having a big impact, doesn't it, when we're talking about scales and how much tax is or is not payable. I guess that becomes quite an important element. And when somebody is facing this, Stuart, I guess it's a good starting point, I guess, is to start understanding tax laws around payments is a fair assessment. I guess that's why we're doing the show today. But as a starting point, where should people be going to start reading and getting in the know?
Yes. So to get in the know, there's multiple sources. You can go to the tax office, but the first crowd to speak to is your payroll. So it's your payroll who will identify each of the components and how they'll be taxed on the separation statement. So when you paid out your redundancy or termination, they'll let you know what each of those components are, and they'll withhold the appropriate tax. And of course, speak to your tax agent as well to make sure the correct tax has been withheld.
So again, just to recap, we talked about age before, so let's just recap on that. So the critical age is the preservation age, so whether you are below or over 60, but then there's also the pension age, so if you are below or over 67.
Yes, good point. So for example, I'm paid $100,000 redundancy amount, only $50,000 is tax-free, then great, $50,000 is tax-free. Now, because I was 67 or over, then the remaining $50,000, how's that going to be taxed? Well, that's an ETP. And so because I'm over 60, it will be taxed at 17%. Again, you need to be, if you are 67 or over, there is no tax-free redundancy amount. So the full amount would be subject to the ETP rate of 17%. My apologies there.
Okay. No, that's fine. And again, I think it highlights that even as a specialist, sometimes when you're dealing with facts, numbers and ages, it gets confusing. I know I've had Natasha Panagis on the show before, and we've talked about super and top-ups and difference between CCs and NCCs, and I get myself tangled up every now and then, and we deal with it all the time. So my heart goes out to people that are never really dealing with this on a day-to-day basis, and all of a sudden they get knock on the door and going, hey, we're going to consider you for a redundancy, and all of a sudden all of this comes flooding in. Now, Can I guess the next question that I think is worthy of consideration then is, how is the tax-free component of a genuine redundancy calculated then? That you mentioned your pay office, but how is that done then? So what are the factors? We've mentioned age. I guess it would also be an amount. Are there thresholds that people need to consider?
Yeah, so a genuine redundancy amount, if you're 67 and over, you don't get this tax-free amount. You have to be below pension age to get this tax-free amount. And it basically, the amount of your redundancy that is tax-free will be a function of the years of service. So as I mentioned, the first $13,100 from memory will be tax-free, but then you get an extra $6,500 of tax-free component, if you like, for each completed year of service. So that's the formula. So if you've been working there for over 10 years at least, then it's going to be $13,100 plus 6,500 multiplied by 10, because that's the way the formula works. And that amount of the redundancy amount will be tax-free.
Okay. Now, Stuart, we've talked about timing as well. And so the whole of income cap we've talked about just then. And so strategic timing, how might deferring termination actually assist people, I guess, after age 60 on tax payable?
Oh, yes. You raise a good point with the whole of income cap there. So that is a cap. It's very complicated. It's a cap that it's an additional cap to consider for high income earners, and that can reduce the amount of your termination payment that enjoys the tax concession. So just be aware of the whole of income cap there. Insofar as voluntarily retiring, if you like, so we're just going to retire, and we're thinking about whether just to cash out our annual leave and long service leave as a lump sum, or whether or not we should just delay retirement, so delay handing in our resignation. Perhaps we want to instead take our annual leave and long service leave in the ordinary course of employment. In that scenario, there can be some advantages to just simply taking your annual leave and long service leave over an extended period of time. So for example, if you just quit today and get paid out your annual leave and long service leave, you're not going to get super guarantee, for example, on that lump sum. But if you remain employed and you just take a long holiday for that period and get your fortnightly salary in the ordinary way because you're taking your annual leave and long service leave, you'll get super guarantee on top of that. So there's a lot of things to consider.
And that's vitally important. So people in private enterprise, that's 12%, and people in the public service, that could be up to 17% of their salary, which is payable in super. And I know I have family that work for the public service. They've decided to retire, and they pretty well all of them take their leave and stay employed virtually, but they have retired, and during that time they draw salary and their super guarantee. So I guess to round out then, we're talking about super strategies. Are there ways to use the super contributions to reduce tax from redundancy or retirement payment? And we need to quickly, obviously, cover for the high wage earners, Div 293. So what's the story there?
Yes. So making additional contributions to super, example, personal deductible super contributions, can reduce the tax on redundancy payments where there's an amount that's subject to tax. So that can be very, very good. And you might also think about catch-up concessional contributions if they're available. Yeah. So if your total super balance is below $500,000 and you haven't yet maxed out on your concessional contribution cap, you might want to think about making an additional a larger concessional contribution by way of personal deductible contribution. That can reduce your tax bill. With Division 293 tax, that's an additional tax, if you like, on concessional contributions where income is above a particular threshold, which is $250,000. So if you're receiving a healthy salary and you also get a large redundancy payment, your income might exceed the $250,000 threshold, meaning that if you do make a personal deductible contribution, it's effectively subject to 30% tax rather than the usual 15% tax, because Div 293 tax is an additional 15% tax to consider.
And I think for those that are considering redundancy and early leave, etc., topping up super is really, really, really important. And I can't stress enough, ladies and gentlemen, that if you are faced with this very good situation, I guess if you are being considered for redundancy, Stuart, you've rightly pointed out, look at your superannuation, and if you can be slamming more and more into your super in that lovely tax haven that we call superannuation, it's a good thing, isn't it?
Absolutely, particularly if you're approaching retirement, you'll potentially be able to access those monies anyways, because preservation age being 60, if you're retiring after the age of 60, you'll be able to access those monies shortly. So yeah, good way to reduce your tax and build retirement wealth.
Okay, so look, we've just about covered everything. These are great papers. They're available on the IFPA site, I guess. And for the tax professionals that do listen to this show as part of their ongoing training, there's some excellent resources on the IFPA site. And for ladies and gentlemen out there, don't forget the ATO, the IFPA site. There's a lot of free resource out there, isn't there, Stuart?
Absolutely, yeah. Check out the IFPA site. There's a lot of publications and resources that are available, as well as the taxation website also has educational material.
Brilliant. Stuart Cherry from the Institute of Financial Professionals. Always a pleasure to have you on Dollars Making Sense. That's it for today. Thanks very much for your time.
All right, enjoy that. Bye.
Bye.